Well, I may start by mentioning a few things which didn't change over the past 10 years. The first one is that if you are not an oil market professional, you have little chance to understand what's going on daily in the oil system, unless you have a chance to have someone like my neighbor getting access to data and be able to carry on a few accurate studies to highlight the day-to-day life. But that requires, turn to my other neighbor, funding for research to be undertaken. Second point which hasn't changed, well, in international markets, oil cargoes very rarely trade at a fixed price agreed between a buyer and a seller. It is not a known feature, but that's a fact of life. Buyers and sellers do not agree a fixed price for a cargo of crude oil. They agree a price formula. So, as a result, at least 80% of the trades done in the international market are referencing their price formation to price indices published daily by a handful of price reporting agencies. I started in oil in the early 80s. That was already the case for refined product. It hasn't changed. As a result of these mechanisms, where there is no fixed price transaction for crude oil cargoes, contrary to the economic theory, in oil, there is no such thing as futures contracts or OTC derivatives contracts, trading forward prices, deriving their prices from spot prices negotiated for physical oil available for prompt delivery. As you do not have spot prices negotiated, you cannot derive forward prices from the spot market. It's, to the contrary, the reverse which does occur. Prices for physical oil derive from the forward prices heavily traded in the financial sphere of the oil market. So they derive from that financial sphere through the price reporting agencies, which are instrumental in creating that link between financial oil prices and physical oil prices through their daily oil price fabrication processes. Basically, price reporting agencies are the bodies in charge for the world economy of bridging the two worlds, financial oil and physical oil. There is no oversight at this stage. This hasn't changed. Finally, what hasn't changed is that oil is not a European commodity. And in that respect, like many other commodities, it opens a different set of regulation possibilities because international issues have to be addressed parallel to domestic market issues. An OTC derivative contract related to the price of a European refined product can be traded between an Indian refiner and the Singaporean office of a Latin American commodity trading house when European regulators are still asleep. Enforcement is going to be a major issue. So, what has changed? Oil price formation entered the radar screen of financial market regulators. That's fine. At the beginning, so 2008 to 2010, the general assumption amongst regulators was that commodity futures markets were under control, hence a focus on OTC markets considered as opaque and therefore suspected of hiding market power plays and price manipulations. As for the other derivatives markets, 3 main recommendations were made to clear OTC derivative transactions. Well, the job is done. Oil market professionals, roughly speaking, clear between 70 and 80% of the OTC trades through NYMEX, ICE, on a bilateral basis today. Second step was to organize post-market transparency through trade repositories, so waiting at the implementation on that. third topic was to enhance transparency in the price discovery process by moving standardized OTC transactions onto electronic trading platforms. This is going to be a major difficulty, given the example I was giving on an Indian refiner trading OTC derivatives related to European indices in Asia. There are some new features which have been mentioned. Well, the new feature is a growing awareness of, amongst regulators of the fragility of price indices produced by price reporting agencies. In this respect, IOSCO has done a tremendous job preparing its report to the G20, which is being delivered these weeks. And we have to welcome that first global initiative in that field. For those who are deceived by what they perceive as a soft stand on these topics, and not as the right first step in the right direction, well, we are given a chance to add to this set of principles they published are answers to the ongoing Commission consultation on price indices formation in connection with the LIBOR scandal. So the door is still open to contribute in that field. Other new topic, well, the growing awareness amongst regulators of the consequential damages produced by electronic trading. Basel III capital requirements give a strong incentive to some financial headquarters to move their proprietary trading away from position taking and focus only on intraday trading, which is not subject to any prudential capital requirement. This tends to gradually turn intraday trading into power plays between powerful algorithmic traders. As a result, enhanced oversight of futures markets will be required. Forcing OTC or derivative contracts to the contrary, forcing OTC derivative contracts to trade on electronic platforms could be damageable. First, because market participants, oil market professionals, will be losing the quality information provided to them currently by OTC voice brokers and result in anonymous trades being the normal way of doing business. And secondly, because by enlarging the number of platforms where you can trade electronically, you are at risk of giving algorithmic traders access to more underlyings, hence to consolidate the influence in the oil price formation process. So implementation of going electronic has to be carefully monitored. Last but not least, and that's new from the press, 11 countries approved yesterday the principle of a taxation of financial transactions. How this may impact the way industrial and commercial companies use derivative instruments in their market risk mitigation programs remain to be seen. So, a few words for the way forward, because I think the job of regulator is not to finalize MiFID, but to prepare for the next round of regulation. Good luck. An in-depth review of the situation as a market practitioner lead to the conclusion that the most common way regulators approached the commodity derivative market so far was potentially in itself contributing to the difficulty. Commodity derivative instruments have not been primarily designed to be used as investment support. They haven't been designed to constitute a new asset class freely accessible to all kinds of investors. So if we limit our regulation efforts to address that view of commodity derivatives, we're going to fail. Derivative instruments were and remain the risk mitigation instruments commodities market professionals need to trade daily when operating physical supply chains, such as the oil supply chain. And regulators should address these markets with only one goal: to improve their efficiency in terms of risk mitigation. In that respect, 3 small proposals, which maybe could be of help. I mean, you never know. Maybe we should start by defining a proper status for commodity trading houses, rather than attempting to remove exemptions and qualify commodity trading houses as providing financial investment services. There is an interesting paper in the FT this morning from Javier Blas ringing the bell, mentioning that the Financial Stability Board is already considering some of the commodity house as potentially creating systemic risk. So we need definitely to go one step forward and be in a position to differentiate clearly between investors, intermediaries providing investment services, and market professionals. Second suggestion, given the fragility of price reporting agencies' price assessments, well, why not to ban investors? So I know to ban investors is something which is not really familiar, but well, to ban investors from investing in commodity underlyings which are not traded on futures exchanges, but subject to price assessment by unreliable price reporting agencies. If we care about the safety of the instruments as investment vehicles, why do we authorize to refer to price formation mechanisms which are not considered as reliable? Can a regulator prohibit something in the marketplace? Third suggestion, well, to extend any HFT or algo trade regulation which are being contemplated for the equity markets to the commodity markets, because it's also creating some consequential damages in there. And why not, based on what you were showing, why not to impose a ban on algo trades linking commodity markets with pure financial markets? Open for discussion.